Risk premium is the income from risk. The risk premium is based on the return on U.S. Treasury bond interest rates, and the excess is the risk premium. This concept of risk premium can be applied to stocks, bond funds, and insurance. For investors, risk premium is also an indicator that can distinguish the stock market. We all know that investment has risks. The higher the return, the higher the risk. The lower the return, the lower the risk. For example, U.S. Treasury bonds are approaching risk-free, and the rate of return is the so-called risk-free rate. If you choose not to invest in U.S. Treasury bonds, you will take a greater risk to buy and sell stocks and choose to bear the risk of stocks falling. Later, the reward for taking risks is the risk premium. The formula for risk premium is as follows. The expected rate of return is equal to the rate of return on U.S. Treasury bonds, plus the risk premium of stocks. Risk premium is a good tool for calculating the rate of return on investment. The formula for calculating the rate of return has just been mentioned. Rate of return equals risk-free rate of return plus risk premium. Suppose the current bank interest rate is the highest 1%, but you want to get higher returns, so choose to invest in ETF, and the desired rate of return is 8%. In this way, you must find investment targets with risk premiums greater than 7% in order to achieve the expected rate of return. There are many financial projects that risk premiums are applied to. 1. Stocks. We all know that investing in stocks has risks. In terms of stocks, companies with small capital, companies with poor fundamentals, and companies with poor stock liquidity usually have higher risk premiums. Take U.S. stocks as an example. You can directly use the U.S. 10-year Treasury bond yield to compare the Standard & Poor's 500 yield and the S&P 500 surplus yield. 2. Bonds and funds. What to pay attention to the risk premium of bond funds? Investors who have invested in bonds must know that commodities will be divided into 5 risk levels: RR1, RR2, RR3, RR4, and RR5 according to the degree of price risk, the risk attribute of the investment target, and the investment market risk. The larger the number, the higher the risk. There are even speculative junk bonds, but they are mainly high yield to attract investors. When investors face high-risk bonds, they should pay attention to the default risk of bonds. Generally speaking, bonds with higher risks and bonds with higher risk levels will have a higher risk premium. 3. Insurance. Insurance will have different premiums due to physical condition, age, and occupational category. In terms of accident insurance, the insurance premiums for workers who go to work are cheaper than those for delivery workers. The pricing of insurance costs is precisely because of the different risks. Older age, poor physical condition, and high professional risk will be considered by insurance companies as having a high probability of claims settlement and increased premiums. All in all, it is generally believed that the no-risk matter itself is the biggest high risk. Only when investors appropriately avoid risks can the expected return contain an appropriate risk premium.